Section 2. The impact of EU directives on the investment industry. First, we look at the harmonization of financial services in Europe. There have been a number of measures taken by the European Union aimed at the harmonization of company and financial services laws of the member states. This is part of the project of promoting a single market in the European Union. A major development in relation to financial services harmonization within the EU occurred in 1999, when the Financial Services Act Plan (FSAP) was launched. It consisted of 42 measures, including 24 EU directives to be transposed into the law of each member state and regulations which apply directly to all member states. The FSAP has three specific objectives: to create a single EU wholesale market, to achieve open and secure retail markets, to create state-of-the-art prudential rules and structures of supervision. These objectives are designed to promote Europe's wider economy by removing barriers and increasing competition among financial services firms, thereby making markets more efficient and reducing the cost of raising capital to industry generally. Since 1999, the European Union has adopted or updated requirements concerning, among other things, the amount of capital which firms should hold, the rules they must comply with when carrying on business with their customers, the controls they must apply to counter the risk of money laundering and terrorist financing, the test to apply when assessing the suitability of new controllers or large shareholders, the requirements they must impose to counter the risk of market abuse, and the disclosures from which companies must make when seeking new capital. Completion of the FSAP within a tight deadline was accompanied by a new legislative approach to developing and adopting EU financial services legislation, the Lam-Folsi approach. The approach is based on the recommendations of the Committee of Wise Men, chaired by Baron Alexandre Lam-Folsi. It comprises a four-level procedure that speeds up the legislative process. It divides legislation into a high-level framework provisions and implementing measures. The arrangements also make provision for legislation to be modified as required to keep pace with market and supervisory developments. Open consultation, procedures, and greater transparency are central to the new arrangements. Financial services legislation in the EU is coordinated by a series of regulatory committees, notably the Committee of European Banking Supervision (CEBS), the Committee of European Insurance and Occupational Pension Supervisors (CEIOPS), and the Committee of European Securities Regulators (CESR). These are sometimes called the Level 3 committees. Finance ministries are also represented on so-called Level 2 committees. These are the European Banking Committee (EBC), the European Insurance and Occupational Pension Committee (EIOPC), and the European Securities Committee (ESC). Since its formation, a number of FSAP measures have been adopted using the new process. The first directives is to be adopted in line with this approach were the Market Abuse Directive and Prospectus Directive. The Markets in Financial Instruments Directive, MIFID, covered in further detail later, and Transparency Directive also followed this approach. In Solvency II, the fundamental review of the capital adequacy regime for the European insurance industry is currently being developed through the Lam-Folsi framework. The Alternative Investment Fund Managers Directive is also currently under discussion. This affects regulation of hedge funds and private equity. Next, we look at the legal status of the EU directives within the UK. In general, this program of harmonization consists of a series of directives issued under Article 58 of the European Treaty. These directives require member states to amend their law. If necessary to comply with them, directives can be implemented by primary legislation or by the more recent tendency of delegated legislation under Section 2 of the European Community Act 1972. This later method may only after a statute, insofar as it is necessary to implement the directive. Problems can arise when a directive has not been implemented by the due date, or the implementing legislation does not properly comply with the terms of the directive. In such cases, a European court has held that the directives have a vertical direct effect. This means that between a member state and a company or individual, the provisions of the directive must be given precedence over the national law. Between two companies and/or two individuals, known as horizontal direct effect. this does not apply. However, in applying national law in this situation, the court should interpret the law in such a way as to achieve the result required by the directive. Next, we look at the Markets in Financial Instruments Directive, MIFID, in detail. One important objective of such a harmonization of trade has been to give firms the right to trade financial services throughout the EU on the basis of a single authorization passport from their home regulator. To ease doubts about the rigors of home country regulation, a parallel development has focused on harmonization key prudential standards. The Investment Services Directive (ISD) created a single passport under which an authorized firm incorporated in one member state, i.e., the home state, may engage in investment services throughout the European Economic Area (EEA) without separate authorization by other member states, i.e., the host states. The passport only allows a firm to provide in a host member state those investment services that have been authorized by that firm's home member state authority. The ISD has been superseded by the Markets in Financial Instruments Directive, MIFID, which was implemented in the UK in November 2007. MIFID has the same basic purpose, but it makes significant changes to the regulatory framework to reflect developments in financial services and markets since the ISD was implemented. Firstly, MIFID widens the range of core investment services and activities that can be passported. In addition to the services covered by the ISD, MIFID includes upgrades advice that involves a person recommendation to a cover investment service that can be passported on a standalone basis. This clarifies that operating a multilateral trading facility (MTF) is covered by the passport, and extends the scope of the passport to cover commodity derivatives, credit derivatives, and financial contracts for differences for the first time. Under MIFID, a company, whether offering services in another member state through a branch or cross-border, may follow the rules of the home state in which it is based. That reverses the 1993 host state rule, requiring compliance with rules of the member state in which business is done. MIFID distinguishes between the investment services and activities and ancillary services. If a firm performs investment services and activities, it is subject to MIFID in respect to both these and also ancillary services, and it can use the MIFID passport to provide them to member states other than its home state. However, if a firm only performs ancillary services, it is not subject to MIFID, but nor can it benefit from the MIFID passport. Investment services are activities, and activities are reception and transmission of orders in relation to one or more financial instruments, execution of orders on behalf of clients, dealing in any financial instrument for an investment firm's own account, including market making and principal dealing, managing portfolios of investments in financial instruments, the making of personal recommendations, underwriting in respect of issues any financial instruments and all placing of such issues on a firm's commitment basis, the placing of financial instruments without a firm commitment basis, the operation of multilateral trading facilities. Ancillary services, i.e. services falling outside the scope of MIFID, are safekeeping and administration of financial instruments for the accounts of clients, including custodianship and related services such as cash or collateral management, granting credits or loans to an investor to allow the investor to execute a transaction, where the firm granting the credit or loan is involved in the transaction, advice to undertakings on capital structure, industrial strategy, and related matters, and advice and services relating to mergers and the purchase of undertakings, foreign exchange services, where these are connected to the provision of investment services, investment research and financial analysis, or other forms of general recommendation relating to transactions in financial instruments introduced by MIFID, services relating to underwriting. Okay, so in summary, the investment services and the ancillary services related to the underlying reference to the derivatives instruments of the definition of financial instruments, where these are connected to the provision of investment or ancillary services, and the underlying reference is not itself a financial instrument, introduced by MIFID. Next, we look at UCITS Directive, the undertakings for collective investment in transferable securities. The FSA gives automatic recognition to certain collective investment schemes constituted in a member state of the EU, other than the UK. This follows from the UK's obligation under the EU Directive on Undertakings for Collective Investment in Transferable Securities, UCITS. Under this 1985 directive, a collective investment scheme which complies with this condition and which is regulated in any member state of the EU can be marketed without further authorization in any other member state, subject only to the local marketing laws. The FSA is responsible for recognizing a scheme under UCITS. The original UCITS directive, termed UCITS 1, was amended in 2002 by a new directive which has come to be known as UCITS 3. UCITS 3 is split into two parts, the Management Directive and the Product Directive. The Management Directive increases the scope of management companies' activities that can be passported to include the discretionary management, safekeeping, and fund administration. The directive also aims to protect investors by ensuring that management companies are suitably capitalized and they have appropriate measures in place for risk management and reporting. The directive also introduces the simplified prospectus, which is an entirely new document that is designed to provide investors with a shortened core version of the current prospectus. While introducing additional features such as performance figures, the simplified prospectus does not replace the current prospectus, and the current prospectus will still be available for all investors. The Product Directive expands the range and type of financial instruments that are permitted within UCITS funds, in particular allowing investment in directives for investment as well as for existing risk reduction purposes, subject to certain risk controls, and investment in other funds. The directive also increases the investment limits for particular types of financial instruments and puts in place a combined investment limit on all of a fund's exposure to any one group of companies. A new UCITS directive is currently being considered within the UK authorities, expecting implementation in 2011. The main changes proposed in the new UCITS directive include a passport for management companies, which will be subject to a prudential and conduct of business measures, broadly similar to those in MIFID, a procedure for cross-border fund mergers, introduction of master feeder structures to permit asset pooling, replacement of the simplified prospectus with improved consumer information disclosure, a new notification procedure for cross-border marketing, and strengthening of supervisory cooperation. This brings us to the end of Topic 1, the UK financial services industry, a European and global context. Thank you.